Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where Dr. Disha Spath will be your companion on this exciting financial adventure. Get ready to conquer debt, build wealth, and embrace a mindful spending lifestyle that will empower you to live life on your own terms.
Doc2Doc Lending offers personal loans up to $100,000 for doctors, designed to help you consolidate debt, invest in your goals, or get ahead financially. Founded by doctors for doctors, Doc2Doc makes funding simple, transparent, and tailored to the medical community. If you're in need of some funds, visit Doc2Doc at the link in our show notes. Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where we help physicians take control of their money, build wealth, and live life on their own terms, without burnout and without guilt. I'm your host, Dr. Disha Spath, and today we have an incredible guest whose story hits home for so many physicians just starting out. This is a sponsored podcast by Doc2Doc Lending, and we're talking with Dr. Zwade Marshall, Emory and Harvard-trained anesthesiologist and interventional pain specialist, Chief Medical Officer of Regenerative Spine and Pain Specialists, and the co-founder and CEO of Doc2Doc Lending, a frictionless lending platform designed by doctors for doctors. Doc2Doc was born after Zwade experienced firsthand how traditional banks evaluate young physicians. Big student loans, low starting income, a compressed credit score, and very little recognition of the incredible economic potential of physicians. Today, we'll explore how his journey led him to build a proprietary lending platform that actually understands physicians, and later, how he helps doctors start and scale their own medical practices. So grab your coffee. This is going to be good. Let's dive in. Dr. Zwade, welcome.
Oh, you raised the bar so high. I hope I can up to it.
Oh my God, I was just reading your bio.
Well, the team sent the bio. I don't know if I describe it as all that. It sounds like I sat in a lab and came up with this algorithm and put the underwriting stuff together myself. And I want to make sure over the course of the time that we spend together that your audience knows that it's okay to have an idea and then get good people in the room that help you figure out the details. But it's all kind of worked out beautifully, only because I've lived the problem that we're trying to solve at Doc2Doc. And so it makes it a lot more authentic. I think I'm able to articulate where the pain points are for us, and then have a team of really smart, financially savvy, financial engineers and risk analysts and marketing folks help us to put together the cocktail that has become a company that's now been very popular with physicians across the country.
Yeah, I mean, I've heard of Doc2Doc everywhere, really. It seems like you're everywhere. I mean, the stuff you've accomplished is really amazing. I mean, it's like 3 lifetimes put together. So, but let's start from the beginning. Tell us your journey, where you came from and what led you to form Doc2Doc.
Thank you. I'm a first generation American. Well, no, I'm the one that moved here. So I guess I'm generation zero. My mom's sister and I moved from the Caribbean, from British Guyana, when I was 17 years old, right before college. So I know that amongst physicians, a quarter of us now have trained somewhere else and come into the United States. So I'm part of that cadre of folks that came here for education and for the American dream. And it's worked out. We moved to New Jersey, Scotch Plains, New Jersey initially. And then I got into Emory for college. Stayed for medical school, stayed for business school. The business part was really only because of it was 2008 at the time, and the Affordable Care Act was being contemplated. I realized that I did not understand enough about healthcare economics to feel comfortable with the conversations that were being had in the political sphere around where healthcare was going. And they say if you're not at the table, then you're in the menu. So we wanted to kind of get more familiar and more conversant with business and medicine. Did the MBA at Emory as well. And in between, I was a high school math teacher. So for those of us who've had other careers and found ways to marry, different parts of our personalities into a career in medicine, I think it's brilliant and great. For me, I couldn't get all the itches scratched by seeing patients. So I get some of them by doing Doc2Doc and meeting incredible folks like you that's helping doctors to find education and value in being a part of a community that understands finance. I get to do this in this role. I don't get to do this seeing patients. And so I think altogether, it makes for a fulfilling kind of life.
Yeah, it's a good point that you bring up. A lot of us that do a lot of different things at the same time, it's just chasing your happiness and chasing what fulfills you and fills your cup. So you went from the MBA, then how did Harvard Medical School happen?
So I had it's funny because I remember when I met my now wife, she's my girlfriend at the time, and I was thinking about what I wanted to do for a career, and there were some medical specialties that I liked that just didn't gel well with having an MBA, because I think program directors were probably a little skittish that they'll invest 6, 7, 8 years of training in me, and then I'll become somebody's consultant, or God forbid, you leave the medical practice to go do something in business. And so one of the fields that was very friendly to business backgrounds is anesthesia. I think few people know that the anesthesiologists are the ones that control the operating suite planning. So think of first case on time starts, OR utilization, the economics around the surgical suite is all done by anesthesia planning. And so with the MBA coming out of Emory, I got a lot of interviews from the top tiered program directors at anesthesia programs that wanted to show me their spreadsheets during the interview process. Say, hey, how would you deal with scheduling here? So it became a calling card for me. And then I decided to go to the Brigham and Women's. The faculty member that made the absolute difference for me was Myrna Lasich. She was a program director at the time. And I remember her in the interview choosing to talk about the time I spent at Emory running an inner city high school mentorship program called the Pipeline Program. And she was so enthralled by my value to that program that a huge part of her pitch was like, look, we think you're a change agent. If you come here, we'll help you grow that part of you, and we'll provide you with the resources to make the biggest impact possible. She didn't ask me about OR utilization studies or gas exchanges. It was all about seeing something in me that she thought she can help me develop and thrive within the Brigham ecosystem. When I got there, she delivered on her promise. And so I made so many good mentors and friends in that environment that has also led to Doc2Doc, because there are probably most of our investors have come out of that system.
Wow. You talk a lot publicly about your relocation from Atlanta to Boston and how traditional banks didn't understand the financial lives of early career physicians. So tell us what happened there.
Yeah. So if you think about it, like all of us that goes through medical school and medical training, we just joked earlier about you choosing UGA over Emory because of the cost of education, right? So
Right.
the average medical graduate now has almost $300,000 of debt. I was no different. I had 212K of student loan debt coming out
That's
of
pretty
Emory.
good. Yeah.
Right,
That's
right, pretty good. Go tell it to the banks. Um, then I had income as a first year at Harvard of $13.12 an hour when you do the math, and my FICO score was in the mid 600s. So when I applied for the loan, and this is just for last month's rent broker fee, the banks said I was a high risk borrower because my debt to income ratio on paper just didn't make sense for them to be able to afford me the loan. And if they did approve it, it was at a credit card interest rate. And the whole process felt unfair because I was matched into a lucrative specialty at a top tiered program. But just forget about even if it's anesthesia and Harvard, it doesn't matter. Like we have stable, recession proof income, and we tend to be quite responsible in our bill paying once we mature into our careers. There are going to be
Sure.
the sloppy pays while you're in school and on the wards, and you forget to pay that credit card bill. And that we're also helping to educate doctors about right now. But we're generally a good bet. So we started our lending program thinking prospectively about a doctor's kind of income arc and their FICO arc, knowing that that debt was all educational debt. It was an investment in self, which
Mhm.
allows them to now earn north of $250,000 a year in income. The average borrower in our portfolio makes $313,000, at the time they start working. So it's no surprise to us that our default rates are industry leading, even though we lend down to a low FICO segment. And so that's the part of it that makes sense for us. And that's led to us being a unique solution for the borrowing crisis.
Yeah. So that makes a lot of sense. I mean, as a doctor audience, we understand that, yeah, we start off like super poor on paper. And yes, of course, we have so much earning potential. Why do banks ignore that?
I think it's a matter of it's their risk algorithms, and they'd rather wait until we pop. So like we're all familiar with buying your first home post training and all the fantastic physician mortgages that are out there. They're
Mm.
innumerable. No money down, no PMI, up to $1 million. But it's already clear that you are indeed a high income earner. It's just
Right.
harder for them to take that risk when they don't know what's happening while you're in residency, fellowship, or even medical school. So it's just a matter of them being conservative from their risk perspective, and
Mhm.
we've begun to kind of lead the marketplace into understanding that doctors will indeed are worth investing in early in their career cycle because we'll make good in it later on.
Yeah. So what factors do you evaluate to risk stratify doctors?
Yeah. So one of the things we do, every doctor that comes through our application platform, we check their NPI numbers and their Federation of State Medical Boards. We want to know that they are indeed a licensed practitioner,
Sure.
because one of the main reasons for defaults would be med mal suits that go awry, or just bad behavior, folks that sex, drugs, and rock and roll, right?
Mm.
That cause doctors to be disbarred. We do care about, are you a first year resident in a neurosurgery residency that's got 8 years left? Or are you a third year in a pediatrics residency that'll graduate next year? We care about where you practice as a proxy for Medicare reimbursement and med-mal insurance, and all the little quirks that makes medicine a unique place to practice. We understand it well. And so we can underwrite thinking about that doctor prospectively and where they will be, not just where they are right now. We do give
Right.
folks a lot of credit for having a challenging cash flow statement where after taxes, income is X, expenses are Y, there's only this much left over. But what do they do with that this much? Do they have some savings? Are they putting something aside for a rainy day fund? If we can see that in their bank account statements, it's helpful for how we underwrite their risk as well.
Hmm. That is, wow, really granular and obviously really impactful for physicians, right? If someone is able to look at and understand these factors that really set us apart from the general population when it comes to banks underwriting loans, that's amazing.
I'll just add quickly that the advent of AI and machine learning has been helpful, right? Like we lever third-party tools, Plaid, for instance, where we can get a quick summary of someone's account, what
Hmm.
matters in that account, and use technology to help us quickly delve into what the ratios are in reality to be able to underwrite quickly for them.
What kind of loans do you underwrite? Are they personal loans? Are they mortgage loans? Are they practice loans?
Yeah, thank you for the question. I think uh, as much as we've been out there, folks confuse our product and lead to some unfair comparisons at times.
Hmm.
This is a consumer loan. It's a personal loan. There's no
Okay.
collateral. So unlike a mortgage or a business loan where they're going to underwrite based on the value of the home, or they're going to look at your business profit and loss statements to underwrite your rate, this loan is completely unsecured. So should a borrower not pay us, we cannot come after their home or their car or their business. It just goes in their credit report. So because of that, we have to be a lot more thoughtful and disciplined in how we underwrite it. But it also means that the rates are not going to be as low as a mortgage or as an auto loan because there's collateral there.
Mhm.
But to offset what can be perceived as higher rates, we offer no prepayment penalties and ease of funding. So let's say you get approved for a best in class loan rate, which is 0.75% per month. Annualized over a year, it's a 9% loan.
Hmm.
But you can pay that loan off in 4 or 5 months and not pay any penalties for the early payoff, which adds a level of flexibility for most of our doctors. Because for many of us, we have a liquidity crunch at a time and moment. Like that fourth-year resident is going to begin to moonlight in a year and will earn more money and can pay off that loan faster. That early career physician who's already in practice but needs to do a renovation of that fix and flip real estate project just needs $70,000 now. They'll do the renovation over the course of the next 9 months, and then they'll do a cash out refinance mortgage and pay us off quickly. And now they've got the equity in that home as well. It's a way to add flexibility. It's a way for folks to consolidate high interest credit card debt. A lot of folks don't realize the impact that revolving debt has on their overall FICO profiles. And those credit cards drag down your ability to borrow cheap capital in the future. So refinancing out of a credit card with an installment loan like ours helps to improve their overall credit profile with the on-time payments with us. So the use cases are innumerable, but to be clear, it's not a commercial loan or a mortgage. It's the life happens loan. Debt consolidation, fertility treatments, weddings. It could be a part of a business loan. You got to do cash flow for 3 months. It's whatever you need it for. And because of that convenience, we've got flexible terms, but the rates are from 9% or 0.75% per month to 2% per month.
Okay. All right. And 2% per month would go up to, what's that annualized?
24.9% annualized.
Okay. All right. So I think this is it's an incredibly powerful thing for people to know that they have, right? Because $100,000, $75,000 in a young person's life, in a time crunch, as we often find ourselves in the medical training pathway, it can be a very powerful thing early on in our lives. If we can open up a pathway to do a fix and flip, if we can open up a pathway to start a medical practice, and we just need a little bit of startup money. If we can, my listeners tend to be more debt averse and very sensitive to interest rates. And I think that's an incredibly important thing to keep in mind. So if you're going to use leverage to build some sort of investment in our life, we need to make sure that it's worth taking on that much risk, of course. But it's a nice thing to know that we have this tool built by doctors for doctors so that you can actually borrow money when you need it, making sure that we actually do pay it back, right? And not sit on it. And so I think that's a really important service that you're doing in the doctor community. So thank you, Dr. Marshall.
Thank you. And I think the way you frame that is perfect because although we're lenders, we agree that our loans should not be used for what you call consumption spending.
Yes.
You shouldn't borrow money to buy stuff and get into more debt for stuff. But there are very important use cases where it makes more sense to borrow money than using your own money. One of our most common use cases is they're going to take our capital to begin the process of opening their own practice. So they've applied to the SBA. They've got a larger commercial loan from Bank of America or somewhere, but that underwriting process takes 10 to 16 weeks to get funded. But the contractor is already sending you bills. The design team is here. You got to buy that ultrasound machine or the C-arm, and you need some immediate liquidity. Our loan is perfect for that. Rather than liquidating your 401k, pulling money out of your savings account, and using it for this vehicle, where now you're likely undoing your path to retirement with a new venture as opposed to borrowing the money and then repaying it when that larger loan funds. It's a more efficient use of capital, and it's not meant to be consumption spending. This is investment into your future self.
This episode is brought to you by Black Swan Real Estate, led by physician investor Dr. Elaine Stageberg. Dr. Stageberg, a Mayo Clinic-trained physician, together with her husband Nick, has spent years building Black Swan Real Estate into a diversified, large-scale portfolio now approaching $500 million across 2,000 doors. Now, through their Secure Freedom Fund, a 10% fixed rate of return offering, you can invest alongside them. The Secure Freedom Fund offers institutional quality real estate opportunities designed to deliver strong cash flow, long-term growth, and remarkable tax advantages. This fund is uniquely structured so that each investor can tailor it to their own individual goals. This fund offers a minimum investment of just $25,000, the ability to choose monthly cash flow distributions, or to elect the compounding option for higher overall growth, the option to exit the fund on your own timing, the flexibility to invest in your personal name, a trust, an LLC, or a retirement account, and so much more. If you're an accredited investor who's ready to diversify beyond Wall Street and invest with experienced, trustworthy operators who've been exactly where you are, visit securefreedomfund.com today to learn more. From there, you can review the slides, watch the webinar, and even book a call directly one-on-one with Dr. Elaine Stageberg. That's securefreedomfund.com. Yes, exactly. Leverage should be used for investment, in other words, right? Leverage should not be used for consumption. I love that. You brought up credit cards, so let's talk about credit scores and debt. Many young doctors, especially immigrants, right, that don't have a long credit history here in the United States, we feel shame or frustration about our credit scores. What do you want them to know?
Yeah, it's a great point. I was there as well. I think as I think about my time in training, we did not discuss finances, financial literacy, financial health, FICO scores, and what it meant, how to game the system, what goes into the credit score calculation. And I think many of us suffer in silence, and we're ashamed of the fact that we'll apply for a loan when we first come out of training, and we'll get denied because we've got a suboptimal credit score. I think first thing to know is that it doesn't define who you are, and with a little bit of attention and some TLC, you can get that score improved. The biggest kind of impairments on the credit reports that we see at our company comes from sloppy pays. It is not automating your payment history. So if you've got a cell phone bill, all of the basic necessities that require monthly payments, automate. Have it paid on repeat and don't think about it. You have a budget in place, so you know that you can afford to cover those basic expenses. But every time you pay on those bills late and you get that 31 plus day delinquency, it follows you for at minimum 1 year, and it will continue to drag your score down. I also think that there's, to your initial question, the credit cards, that bit of revolving debt and credit utilization, it's poorly understood. You've got a card with a limit of $10,000 and you're using 9,500 of it, that's hurting you every month. If you pay it down, but don't close it, keep it open. Now, if you pay it down to 1,000, you've taken your utilization down to 10% instead of 90%, and that adds to your overall credit score. So you don't want to close those accounts. You want to increase the credit utilization ratio of having more credit available to you. That helps your overall credit score. Be careful about lenders who ding your credit every time you look, because if you're looking for loans and the credit bureaus see that people are checking your credit report a lot, that also can lower your credit score over time. So there are a couple of just key factoids about credit that we just don't understand because we weren't schooled on it, that can be very impactful. There are a bunch of resources out there, Credit Karma, myficoreport.com. They'll give you free access to your credit scores, and you can update it every quarter. In this age of identity theft and fraud, it's important that you check, just because you never know when someone's infiltrated your account, taken out loans in your name, and then you don't know about it until you need to access credit. You don't want that to be the case either. So just knowing where you are and how your scores are trending is going to be important for that as well.
So important. So important. Most people don't realize that actually opening up a new credit card and having just more credit available to you increases your credit score. It's crazy, right?
That's right.
Yeah. I mean, of course, they're going to do a credit check before they give you that. But in general, that credit utilization score is really so important. And the credit history, how long that credit card's been open, is also so important. So even if you don't want a credit card anymore, just downgrade it to a free card and just keep that line open. It makes such a difference to your credit score. And yeah, all this stuff we don't learn as immigrants, right? Especially as immigrants, because like in other countries, credit scores are not as important.
Yeah.
Yeah, it's not a thing. But here it is. So yeah, I think I'm so glad you went through that. Can you walk us through what applying to Doc2Doc looks like versus a traditional bank?
Sure. So we're virtual. There's no brick and mortar store. There's no lines. There's no turnstiles. It's all online on your phone. So easy and convenient. It's doc2doclending.com. That's our website. And if you click on that link, it'll lead you to answer a series of very quick questions about your demographics. And we're able to match through API plugins with your bank account, with your NPI number and the like. But it takes the average user about 2.5 minutes to complete the application. We can then give a decision right then, within about 30 seconds.
Wow.
And if it's an approval, the next step will be for you to see fully transparent terms. We will explain exactly what you're going to be paying on the loan, what the total interest paid will be, what the monthly interest and the annual interest, all very clearly stated, and give folks the option of paying interest only or the entire principal and balance while they're in training, to give them some flexibility in the monthly payment as well. If the borrower says, yep, I want to proceed, we'll then verify identity using an API on their phone, where they kind of just do a verification check that can be done in a matter of seconds. And then we can fund that loan once they've been approved within a matter of 3 to 5 business days.
Wow.
So from beginning to end, call it 5 days from application to funding. And then, of course, when a borrower gets accepted in, they have the opportunity to speak with one of the physician members of our team. So someone will say, welcome, Dr. Spath, to your Doc2Doc family. We're happy to fund this loan for you. What is your use case? And we'll have a chat about what they're using the funds for. We even at times may recommend that they don't take our loan if there's a better product out there in the world for their use case. Like if we had a borrower called to borrow money to pay for an x-ray machine. Like this is not a good use of funds for us. There are equipment funding loans out there that'll give you a lower rate and an extended term, and it's a collateralized product, so it'll be better terms for the customer. Don't borrow from us for that. Here's a partner that can fund that for you. So we want to make sure that anyone that uses our platform feels the sense of empathy and the sense of affiliation, that we understand who they are and where they are, and that we're a partner to their journey in their careers and not just a lender looking to extract profits from them.
So you funded thousands of loans for doctors. What are some success stories that stand out in your mind?
Yeah. So yeah, it's been over 5,000 loans, $173 million worth of loans, 4.9 stars in Trustpilot. We're really proud of it. I think that, there are a few stories that really stand out. I think one of them, we've got an O1 visa, our first O1 visa applicant. That's the Einstein visa. So if you're an immigrant, you may know what it is. If you're not, it's the same visa that Luka Doncic has, by the way. So if you have rare and exceptional talent anywhere in the world and you come to the US because you got a patent on something or you're going to be working at some research lab, that's the visa type. So if this brilliant student coming out of Beirut, Lebanon, was borrowing to pay for fertility treatments for he and his wife, went through the process of trying to apply for loans here and couldn't get funded anywhere else, and we funded the loan. In the course of the funding, we knew that he was paying for fertility treatments. They were building a family. He was nervous about it. He and his wife were looking forward to their first kid. And it's, again, this kind of community feel to being a cheerleader for someone's journey. 8 or 9 months after funding the loan, he reached out to our team to share the ultrasound of that they'd conceived. And I think, who sends a lender an ultrasound report when they conceive? Who does that? And it spoke to us in that he's describing us the way we intended to be perceived as a company that's looking out for our peers. We've got a sad story of a couple who were dental students in New Orleans, and they had a kid who had Fanconi's anemia, and they were paying for that child to go to the Mayo Clinic every other month for transfusions, and it was tough because a lot of out-of-pocket spend for them. So we were helping them to fund those treatments, and we knew the journey. We were sending messages of encouragement throughout the kids' treatments, and then unfortunately the baby passed away, and so we were a part of that with them as well. And so this is a human experience company. Like we I think doctors are perceived to be superheroes. We put a cape on, and we're Teflon and perfect and have great credit scores and have no financial hardship. But those of us in it, We know how isolating it is, how much imposter syndrome we experience, how ashamed we feel about having hardship and not having it, knowing where to turn. And so, what we hope that our members experience with us is a group of folks that really get it and really care and want to see them do well, if it's with us or not with us. And so we've been most proud of those stories.
I love that. Oh, gosh. And I love that the examples you shared were investments into human beings, into our families, into, our well-being as well. Borrowing for investment doesn't only include like the traditional investments, right? It's also our children, it's also our families, and those are often the most gratifying investments. So I love that you shared that with us.
It's also the ones that are most painstaking when you can't find the money, right?
Right.
Think of the
Yeah.
desperation. Like when we say yes, it's funded on the phone to some of our members, you hear them begin to cry because they've heard no 4 or 5 times before. And so there's this anxiety and this real relief when we say we can do it and it'll be in your account in 5 days. And you kind of feel like, are you serious? Is that true? And so those, to your point, those kind of human interest stories, those investments in the people that we love, when you didn't have the money, it's awful.
Yeah. So, what if you're a doctor listening and they want to actually invest with you? What if they want to be on the lending side of things? How can they get involved?
Yeah, thank you for the question. We're actively doing a raise right now. They can contact me. We'll leave my information in the after summary. But it's Zwade at Doc2DocLending.com. We've raised so far $23 million in equity from physicians across the country, which is incredible. Like all retail investors. Like when I say it's a for us by us company, it's because you all have showed the confidence in what we're doing to put your money behind it. And we've had the last raise that we did, we had our first cohort of borrowers become investors, which was incredibly thrilling to see. That looks like I use this product, I want to be able to help, and I want to put money in. Now it's not a nonprofit. There is a return on investment, and it's an equity investment. So the point here is that the money that you invest goes towards loans, but also goes towards growing the platform and growing the business. So in our first year back in 2020, we did $2.3 million worth of loans. We're going to end this year having done about 48 million in loans, right? And so that growth adds to enterprise value. So you're a shareholder in the company. And so if and when we have a transaction, we get acquired by a bigger lender who wants to serve doctors and wants us to be a part of their ecosystem, then our investors get to cash out and get a multiple return on their investment. So happy to speak more in depth about the investments, but I know that our investor base has been thrilled with our progress so far.
Awesome. Okay. Well, Dr. Zwade, let's break things up with a rapid fire segment. Lighthearted. I'm just going to throw a couple of scenarios at you. So tell me if a traditional bank would say approved or denied and what Doc2Doc would do instead. Ready?
All right, let's go.
Okay. A new attending making $260,000 but still has $350,000 in student loans.
Yeah. So a traditional bank would say yes, but it'll be yes, but you're going to pay north of 25% in interest. And you're going to have to show us all of your bank statements, all of your properties, all of your prior business interests to underwrite the loan. It'll likely take them about 6 weeks to get to a yes, and then you'll overpay for it. Doc2Doc will say yes immediately and fund it in 5 days.
And by the way, I should clarify, this is for personal loans, not like mortgages or anything.
That's right. Yes.
Right. Okay. So a physician switching specialties looking for a personal loan because they're taking a pay cut for fellowship.
Right. Great question. So that's really challenging for traditional banks.
Yeah.
Any decrease in income is a huge red flag because they will ask for tax returns. They want to see the last 3 years worth of tax returns, and negative income will be a trigger that'll ask them to look for more. So you have to now prove that you'll be able to replace that income in the future. Doc2Doc, we understand career transitions. We understand locums tenens as well. So the doctors that don't have W-2, right? 1099s. We also
Right.
understand that many doctors will own other assets and depreciate their income for tax mitigation strategies. So we know what that looks like as well. So a main part of our underwriting is looking at your account history, not just tax returns like the banks do.
Mm-hmm. How about a doc with a 690 credit score because of moving, relocation expenses, board exam fees, and they're looking for a personal loan? What would a bank say?
So most banks will say no. Many of them have for a consumer or personal loan have credit criteria of cutoffs like 700 to 720. The ones that are a little bit lower say 680. So that borrower will be at the very highest rate of someone that says yes.
Mm-hmm.
Okay, because cutoff is 680, they're at 690. Our cutoff is 600 for in-training docs and 650 for established doctors, and then
Oh,
we
wow.
will get credit for cash flow near the thing. So it's unlikely that a traditional bank will say yes to that borrower. The ones that will say yes will be at a high double-digit interest rate, and we will likely get them approved at a reasonable rate with no penalties for prepayment.
Love it. How about a brand new practice owner needing capital before insurance reimbursements start coming in?
So that was me. So I know, oh, that's tough. So I tell our entrepreneurial doctors all the time that it's better to stay in your primary gig and open your new practice while you still got W-2 income and transition slowly over. I know for many of us, we're frustrated with the hospital or with the employer, and you're looking forward to the day to say, I quit, I'm out, I'm going to go start my own thing. But the challenge with doing that is that the banks find it really hard to fund a startup, right? And so there are very few that have programs in place for it. The ones that do, it's a really lengthy process, and you oftentimes will have a hard time getting the cash to fund the business while you're waiting for insurance payments. Now, there are companies that will fund what's called accounts receivable loans, factoring loans, where they'll say, okay, you've got $80,000 worth of treatments that you're waiting on insurance reimbursement for. We'll fund 60,000 of that $80,000, but you'll pay us the 80,000. So they're very expensive loans. And so it's something that you need to really be thoughtful about. And if you're going to get a larger SBA loan or a practice loan, you need to go ahead and put in your budget the operating expenses for the first 6 months as well. Doc2Doc can step in if you haven't done that work, and we can give you the loan for up to $100K based upon you being a physician, you having income of some sort, and that would be helpful there. Now, I will say, if you've got no income from the practice and no income to show us, we couldn't approve that loan either. So you must have had some income coming in to be able to repay the loan for us to be able to fund it as well. So you've got to be doing locums tenens or having a job somewhere to help to fund the practice.
Yeah, makes sense. Makes sense. How about a physician who has a perfect financial future on paper, but no W-2 income yet?
Yeah.
But same question.
So those ones are hard to fund for both of us, for banks or Doc2Doc. Great credit profile is great, but we all need to know there's ability to repay a loan. And so if you've got a contract in hand, we can fund that loan. So if you're within 6 months of starting that job and you've got an executed contract, we will assume that the money that you will make is your current income and give you an approval based on that.
Zwade, this has been such an empowering conversation, from understanding why doctors are misunderstood financially when it comes to personal loans and how we can take control of capital and start building our real wealth. I feel like I've learned so much, and I hope my audience has too. For anyone listening who wants to learn more, make sure you check out the link we have included in the show notes for Doc2Doc Lending. If you enjoyed this episode, please subscribe, leave a review, and share it with a physician who needs a little extra inspiration today. This is Finding Financial Freedom with the Frugal Physician. I'm Dr. Disha Spath. Stay frugal, y'all.
The content shared on this podcast should not be taken as individualized financial advice. We are here to share our knowledge and experiences, but it is crucial to consult with professionals such as accountants, financial advisors, or attorneys who can provide personalized guidance based on your specific needs.